Welcome back to Financial Market Insights for Traders. I am your host, Sophia, and today I want to take you through a full journey. We are looking back at everything that shaped 2025, and then we are looking forward to the forces setting up the year ahead. This episode is going to be long, clear, and packed with detail because the goal is simple. By the time you finish listening, you should understand exactly what the past year taught us and what the next one may hold. Nothing gets summarized or brushed aside. Every major point stays in. So take a breath, settle in, and let's walk through the full story of the markets. If you traded or followed markets at all in the past year, you already know that 2025 did not give anyone a smooth ride. It was full of optimism, hesitation, rotation, and constant resets of expectations. The best way to describe it is that it rewarded patience and punished anyone who tried to predict the future too confidently. The 2025 market recap S and AMP Wink with Tongue Sticking Out 500 tells a story that is almost like a loop. Confidence built up, something shocked the market, then the market adjusted, and then the cycle repeated. The year opened with a clear wave of enthusiasm. Traders expected a long list of rate cuts. Analysts kept talking about easing financial conditions. Tech stocks jumped right out of the gate, especially the mega cap names tied to AI, semiconductors, cloud infrastructure, and automation tools. These companies had already carried the market for years, and once again they delivered early gains. If you were trading in the first quarter, you could feel the strength. Breakouts were clean, the tape felt firm, and momentum traders had plenty of setups. But by the middle of the year, things changed. Inflation readings came in hotter than expected, and that one shift hit every corner of the market. Rate cut expectations faded. Bond yields jumped. Traders who positioned aggressively for easy money suddenly had to unwind positions fast. The S and AMP Wink with Tongue Sticking Out 500 saw short periods of sharp selling. Sentiment dropped. And for a few weeks at a time, you would hear people say that the market had overextended and that a full reversal might be coming. What actually happened was far more interesting. Instead of falling apart, the market broadened. This was one of the most important themes of 2025. The strength did not just sit in megacap tech anymore. Investors rotated into industrials, energy, financials, healthcare, transportation, and several consumer names. You could see money moving into companies with stable cash flow, clearer earnings expectations, and more reasonable valuations. The broadening of the rally made the market healthier. The S and AMP Wink with Tongue Sticking Out 500 ended the year with strong double-digit gains. Pullback still happened, but buyers came in faster. Traders had more sectors to work with, more setups to choose from, and more opportunities to diversify. This is why so many people described 2025 as a turning point. It helped the market grow roots in places that had been ignored for too long. Now, why did the year play out this way? It came down to a few core forces. First, interest rate expectations shifted constantly. Markets spent the entire year adjusting and readjusting to every inflation reading and every Federal Reserve comment. This was the heartbeat of the market. Whenever rate expectations moved, everything else moved with them. Second, the consumer cooled but did not collapse. Spending slowed, but it stayed steady enough to support earnings. Job growth was soft but still positive. Wage growth eased off its peak, but stayed above pre-pandemic levels. Households made smarter choices rather than shutting down spending altogether. This steady consumer behavior gave companies a platform to work from. Third, earnings were stronger than expected. Even with cautious guidance, companies beat forecasts repeatedly. Cost controls improved. Productivity from AI tools actually started to show up in reports. Companies used automation to reduce routine workloads, clean up operations, and protect margins. That made earnings one of the most supportive forces for the S and AMP Wink with Tongue Sticking Out 500. And finally, the global backdrop stayed messy, but never broke. China moved in fits and starts. Europe dealt with energy issues and slow growth. Emerging markets wrestled with currency swings caused by U.S. rate expectations. None of these became a global crisis, but each one added noise that traders had to work through. All of this built the foundation for where we stand heading into 2026. So let's shift to the future. What should traders and investors expect in the year ahead? Most forecasts say growth will slow but not stop. The labor market will cool more. Business investment may ease. Consumers may narrow their spending categories. But the current outlook still leans toward a soft landing rather than a recession. Productivity improvements could become a major safety net for earnings and economic activity. Companies have gotten better at doing more with less, which may help support them through a slowdown. Rate cuts are possible in 2026 if inflation keeps drifting lower. Even a small number of cuts could make a difference, especially for sectors like real estate, financials, small caps, manufacturing, and parts of the consumer economy. But the timing of these cuts will matter more than how many actually happen. Markets will react strongly to the communication coming out of each Federal Reserve meeting. Earnings will be a key driver of market sentiment. If companies protect their margins and deliver results even in a slower economy, the S and AMP wink with tongue sticking out 500 can stay stable or even move higher. If margins come under pressure, volatility will increase. And that pressure can come from labor costs, energy costs, or supply chain disruptions. Then there is the global landscape. Policy changes, election cycles, geopolitical tensions, and commodity markets will continue to send surprise shocks through risk assets. Traders will need to stay aware and ready to adapt. Now let's talk about the biggest risks traders should watch in 2026. These are the risks to watch 2026 economy that matter most. 1. Inflation could stay stubborn. If inflation gets sticky, the Fed will delay cuts and keep conditions tight. 2. The consumer could slow faster than expected. Higher credit costs, weaker hiring, or rising debt stress could cut into spending. 3. Corporations could face margin compression. Costs might rise while pricing power fades. 4. Global instability could hit markets. Geopolitical risks, trade challenges, or energy volatility can change sentiment fast. And 5. Credit markets could show more cracks, especially in commercial real estate or heavily leveraged sectors. Every trader should keep these risks on their radar because any one of them can move the market suddenly. Preparing for the year ahead means using the right tools, staying educated, and staying flexible. If you want a world-class, cutting-edge, user-friendly trading platform that gives you speed and clarity, visit crystalballmarkets.com/platform. This platform is built for traders who want a clean interface and powerful tools. I invite you to check it out and sharpen your strategy with a platform designed for modern trading. And if you want beginner-friendly explanations on trading, investing, macro trends, and financial markets, you should listen to the Crystal Ball Markets podcast on RSS. You can find it at our ss.com/podcast/crystalballmarkets. It is simple, clear, and made for anyone who wants to learn without being overwhelmed. As we wrap up, the lessons from 2025 are clear. Stay flexible, stay informed, and stay ready to adapt when the market changes direction. The year ahead will have opportunities, but you need the right mindset and the right tools to make the most of them. Thank you for spending this time with me today. I am Sophia, and you have been listening to Financial Market Insights for Traders. I will see you in the next episode.